Let's start with private equity, which is obviously the significant component of the alternative capital universe. One of the big issues we have right now is this huge amount of dry powder, I think around 2 trillion, a trillion of which has been added since 2013. The obvious question is, where does it all go?
Well, we're seeing larger and larger deals happening all around the world, in Japan, in the US, in Europe, and this will continue to drive the growth of the industry. I think when you look at the underlying elements for this, there is activism that is putting pressure on a lot of companies. So corporate carve-out has fueled the market over the last year. We've seen here General Electric, United Technology in Europe, Nestlé, Siemens, ThyssenKrupp. And then also public to private. I think as the equity markets start to be volatile, private equity find the opportunity to take this company back in their hands.
And a lot of the deals we've seen being done, and this is likely to continue, the if you like, the leverage ratio is going up. So I think it's a lot above 7 times now. I think 40% increase in deals above 7 times just in the US in the Trump era. Is that sustainable if we keep seeing that sort of creep up? Do we get back to a level where there's just too much risk in the private equity market?
The interest rates are very low though, and this compensates a lot the high headline leverage numbers because the real cost of debt and the interest burden of the companies is much lower than I think it can come from outside. Also, a lot of the deals are interest only, and I think you need to assume that these companies, you will be able to sell them or refinance them down the line. I think what we learn both as banker and private equity is that we need to structure our deals much more carefully, so there will be early warning system to prevent us from going in the issue we had during the crisis.
And another thing that's sort of crept back in recently, which was again something we saw going into the last crisis, was a return of the club deals, the sort of the sponsors getting together to execute these very large transactions. How are they de-risking that? Because that was a headache when we kind of got into the unwinding phase of the last crisis. How do they avoid going into that this time?
Listen, this consortium, in my view, are the result of the fact that the deals are getting bigger, but also that alternative pool of capitals, i.e. the sovereign wealth fund, the pension fund, have understood that to maximize the return, they need to invest directly. So they ask all the GP to allow them to open the capital. I think what's going to happen in the next crisis is that they will need to be more aligned, better aligned in dealing with issues and situations, and that they are on the way in, the governance and the term sheet they have between themselves are much more prescriptive than they had before, because they've all learned that to agree on difficult situation on a different time can actually lead to very bad outcome. So we're seeing now many more discussion up front where they team up, and that leave less discretion when then they need to exit or to take dramatic action with their businesses.
I want to pick up on something you mentioned there, which is these very large deals that we're seeing being done, or very large companies. And one function of the private market or the alternative capital market at the moment is you see these sort of vast companies get really, really big under the administrations of private ownership, and then sort of struggle to come public or struggle to find a meaningful exit. And WeWork obviously is the example du jour, but we've seen others, Uber most notably recently. How did the big private owners manage this issue of companies getting really vast under their auspices and then not having a natural exit?
I think they do it in 2 ways. Either if the public market is not there, and remember, the public market is open and closed at different points in time. So if you're patient enough and opportunistic enough, you probably always find the right window to take your company public. And it's a question of valuation and the size of the offering. But there is also this alternative pool of capital. So very often we see private equity wants also to hold on to the asset a bit longer, selling a minority at 20, 30 or 40% to a pension plan and sovereign wealth fund. And this allows them to monetize, to return some money to their LPs, but also to ride some of the upside on their investment. And then when everything fails, you go back to break up and sell it in pieces to strategic investor. And we've seen this a lot.
And to your point, you need that kind of alignment. Another issue which is sort of always of interest is, as the big private equity becomes more like traditional corporates in sort of owning these assets for a long period of time, you say patient capital, institutional management, etc. And you're also seeing alternative or shadow capital coming into the traditional private equity space, you have this mass convergence. Does it become harder for traditional sponsors to justify the fee delta between what they're doing and what you would see in a normal equity market?
I think the reason why they can still justify charging decent management fee is the operational expertise they bring to these companies. So a lot of this alternative pool of capital, the pension fund, the sovereign wealth fund, they're not geared up. They have smaller team. They don't have the global network, and therefore they rely on their partner to really go hands in the business and pursue a strategy that can be operational improvement, can be buy and build, or global expansion, or in most cases, all of them. So that's why I think the private equity earns their back by really becoming much more hands-on on the management of the business. That is very different from when this market was originally, when the first LBOs were done. And
when it was just financial engineering.
It was much more financial engineering.
Which brings me on to the last thing I want to ask about, which is we've seen a sort of retreat from some of that hardcore financial engineering, and indeed the market has punished some of those private equity firms we think of as being best at that, 3G being an obvious one, Bain another. How do they manage that transition to go from being financial engineers to actual operators of businesses?
Is by hiring the right people. So we're seeing more and more PE going out and bringing operating partner, bringing CEO of real businesses, because they realize that the deal guys can have the intuition, have the guts, but then when it comes to really go in the company and help a CEO to implement a strategic vision, they need real experts. So you're seeing more and more that this PE increasing the ratio, what they call portfolio team or operating team, they really help to drive the growth.